All right. Good morning, everybody. Before we get started, I wanted to let everybody know we're working on putting together a webinar. They're going to come in. Options Omega here is going to come into the Bullish Bears Discord and present a webinar. I think we're aiming for the 20th. This is a back testing company. They are constantly updating this thing and making it better. They actually got it down to 1 minute charting on the back testing. And I was just going through here for an example, looking at iron condors. Haven't really been able to do the iron condors the way that we used to on a week-to-week basis using the Friday expected move because the range is too big, right? If you try to allocate your strikes and set your break even on those weekly expected move lines, they're just so far away that there's no profit in it, right? So your losses overtake your wins. And so I've been trying to figure out what would be a better week-to-week iron condor in our current market using the kind of market conditions that we haven't seen in forever, right? How do you try to use backtest data if you are in just a regular chart or listening to someone who's talking about the way they did irons 10 years ago? Doesn't matter what they did 10 years ago. We're in unprecedented market conditions. Need something that can evaluate the current conditions. And this back test that you're looking at right here is what I ran this morning year to date. So it's like from January to today, running a week-to-week iron condor, 7 days to expiration, put them on a Friday. And we're looking at 95% win rate, which is a little odd, right? When you think about the win rate on that. But the reason it's such a high win rate is because I dialed back the target profit to 29%. And I took the stop off of this thing. The stop was actually causing a couple of losers that wouldn't have been losers if the stop hadn't been in the way. So anyways, these guys are going to be coming in. They're going to be doing a webinar on the 20th. And hopefully I'll see everybody there. I think you're really going to appreciate this if you're an options trader trying to figure out what kind of options trades should you be attempting to do in the current conditions, and how much do you have to change, right? The strikes we use, the days to expiration, the target profits. What do you need to change to be able to use those strategies that we've always used in a market like this? They are going to be offering a real big discount, about 50% off of their product. So if you're looking at this today and you see the price and you kind of choke a little bit, they're going to hook us up, guys. They're going to give us a big discount. So let's see y'all in the class. All right, so we want to go over and take a look at Finance Juice. Kind of ask the question, is there anybody going to be out there chipping their teeth today? It doesn't seem like it. Right, everything seems to be pretty clear there. We have no guest speakers, and that makes sense because they're in that blackout mode, right? That quiet mode. There is the 10-year today, so that one's really important. Remember, they're letting the balance sheet run off. We are also, and it's the name of this stream this morning, we've got inventories today. And there's a phrase out there worth studying: inventory corrections, right? So, if you're an analyst trying to figure out what's going on, you don't wait until you get all of this data and see what the outcome is. You start catching things early. Check out the phrase inventory corrections, and then you'll have a better idea of why today's numbers are going to matter. Another thing that we want to look at when we're on Finance Juice is the European market wrap. There's a wrap for the Asian market, the European market, and then there's a wrap for our market at the end of the day. These are really useful. Europe's not closed yet, but it's still useful, especially if it'll point out what sectors today in Europe were doing good. Asia has had like a 9% move in the last week to the upside, because they're signaling that they're backing off on such a heavy hand against like the gaming industry, video game, and their tech. So there's been a huge lift off over there, and we're not seeing it over here, right? Other than, there's a few names, but as a index, we haven't really seen it here. If there was anything of concern, it would stand out, and that we want to look for anything as a global risk. And the analogy that I use in that, or the example that I like to use, is when that really big ship got stuck in the canal, right? That was a global situation. It was covered on every news outlet. It's a really big deal. So don't go looking for trouble. If you stick your head in here and you look around and nothing really stands out, there's nothing there. You let it go and move on. Wholesale inventories, 10 a.m. Inventory correction. And then we have the 10-year note at 1 o'clock. That's a big one, guys. Really watch that today, 1 o'clock. Be ready for an absolute shift in market sentiment. And if we don't get one, hey, fine, no problem. But you can't say, oh, I didn't know that one was going to be important. It's going to be important. As usual, from time to time, we want to come out and take a look at the daily chart, have a discussion on it. As a trader, you should go out to this daily chart every day. And I hear time after time a futures trader who says, well, I'm an intraday trader, I don't look at the higher time frame. You're making a big mistake. You don't want to deliberately ignore information. We are yet again this morning inside day. Today's candle is inside of yesterday's candle. We are in an IX10 pattern at this point. If we were to just roll back to the controlling candle, we've wicked outside of it, sure, but this is the range. And you could even take that back farther and consider this the controlling candle. And again, sure, we've gone outside of it momentarily. Otherwise, we've predominantly stayed inside of this. The longer we stay in one spot like this, winding up, that's exactly what we're doing. We're just winding up more and more and more and more energy. Now, there's no promise of a direction here. It doesn't imply that we're going to go up or go down. But when we spend these periods of time consolidating, we often get a very large move when the consolidation ends. And that's what we want to be focused on here, especially if you're beta weighing your portfolio and kind of asking the question, could you withstand a 10% run or a 10% fall? And how much would that hurt or benefit your portfolio? And how much of a hedge should you be allocating or carrying right now. We got an ADR at 2.4%. We are inside day. It is worth breaking these days down into what I call quadrants. So if we focus on the lowest part of our own Globex to the highest part of our Globex, we could consider that zone 1. They're close enough together that if you consider the high of yesterday and the low of the Globex as one quadrant, I think you would do yourself a favor. It's so close. There's no reason to try to have just a very little quadrant right up there at the top. On the other side of that, from the low of our Globex to the Globex high of yesterday, although it's a narrower, much narrower zone, I really feel it needs its own position. And then the absolute low of yesterday to the high of the Globex would be the third one. All of this would be considered the range day. So if we're looking for an inside day breakout, we're much closer to the top of the range than we are to the bottom of the range. Now, that doesn't mean that we're more likely to break up than down. It's just that we're already there. Should we get a break to the upside, we would want to start with where we closed at 4. Measure out 2.4 to the upside. And that gets us right around 42.60. That would be our ADR in an upside move. And remember, the ADR is not the extreme of the move. That would be considered normal. So if you're thinking that that looks a long ways away, we've said that before, but that is not out of reach. And then on the other side of that discussion, looking at it from the other direction, (2.4% to the downside would be, we'll call it 40.60. And that would be our ADR range for the day. Now, what's much more likely with us waiting on these numbers is that we just continue this range until Friday. So with that in mind, you really want to kind of map out yesterday's pivot points. And we call it mapping out the 5 by 5. Yesterday's pivots would be yesterday's high, the open, the Globex high, the Globex open. You could hit the close, but again, those are really tight numbers. Our own Globex low of today. And that would give you a considerable amount of pivot points to focus on. And then, of course, you got the low of yesterday. It still does leave some dead zones. But the reason we call it mapping out the 5x5 is that in this area where it's dead, or that there's not a lot of pivot points, you would look back even farther and see what else is there to mark any of these other pivot points. The low of a previous day, for an example, carried across would give us a pivot right around that 40.90 area. Or the open of this day would give us a pivot point right around that 41.50 area. So when you map out the 5x5 and you catch all of these pivot points, these are institutional pivot points. There's consistency in that, marking the open, high, low, close of previous days, carrying them forward into today's price action. So that now when we're focused on today, you can see there's a lot more levels, zones, quadrants, pivot points with validity behind them. So the 5x5, that's like 5x5, means that you're looking at a 5-day, 5-minute chart. Now, granted, I'm on a 15 at the moment, but the phrase comes from looking at a 5-day, 5-minute chart. And that on that 5-day, 5-minute chart, especially in a market that looks like this, instead of a market where we've ran for 5 days up or if we fell for 5 days down, we have 5 days in a row where all of our pivot points are lined up, right? Because we haven't really gone anywhere in 5 days. If you were to map out these open, high, low closes over the 5 days on a 5-minute chart, you would have all of these pivot points. So mapping out the 5x5. And as you can see on the intraday here, we've got goalposts or signposts, targets that we would aim for. If we get through this, we're headed towards that, right? And then when we get there, what do we expect price to do? Do we think it's going to bounce there? Is it going to break that level, go through that level? And that way, when we're looking at the dome and we're watching the order flow, we can see, are these levels being defended? Are we going to make it through that level? If we get on the other side, what are we going to do with it? Where are we going to go with it? And for me, I really like it because it helps try to identify how much heat am I willing to take when I get into this trade, because I have a destination in mind. I may have a 5x5 video on my YouTube. I don't know if it's public or not. It's worth looking just to take a peek. All right, so we're looking at a 10-day, 30-minute chart. And one of the things that I always try to draw everybody's attention to is how big is the volume profile? How wide is that area? And as you can see, it's a really, really narrow range at this point. Between yesterday and today, we dropped off a lot of the candles on the back side of this thing, right? That's how it works. We print a new candle here and we lose a candle off the back end of it. Now, I've never gone in and actually counted all of these candles up, but if you were, and just for some rounding numbers, some easy numbers, say we have 1,000 candles here. And I know that that's probably a real inaccurate number, but we just need a number to talk about. If we have 1,000 candles here, every new candle on the front kicks a candle off the back, and we still have yet again another 1,000, right? And so it's always 1,000. The volume profile was really wide yesterday because there was still a lot of volume being measured off of the low end of this thing. And as you can see, even right now, there's still a lot of volume down here. And we're going to be dropping that volume off today. As we move through today's session, we're going to lose a lot of this volume. And the entire volume profile is going to shift. But for the moment, we've got this very narrow range. And then from this, we want to kind of ask the question, are we at the top of the range or the bottom? When we are at the top, we expect to be moving towards the bottom. And when we are at the bottom, we expect to move towards the top. Are we inside the box or out of the box? Are we continuing to drive farther away? Or are we actually coming back towards the box again? These are the kind of things that we want to think about in the morning as we're planning ahead and looking for where do we think the market's going to go. The what's more likely works a lot, right? Just kind of asking that question, what's more likely? Say we've already made a 2% move in the pre-market. What's more likely, that we make another 2% move in the same direction, or that we now pause because the market's already accomplished everything that it needed to accomplish for the day? It doesn't mean you're right, but what you'll find if you try to game it out, rather than focusing on, oh, I have a rising wedge, or I have a head and shoulders, or I have this pattern that says blah, that the what's more likely question gets you a lot farther than this arbitrary pattern that you may or may not find. The profile in blue is time. So we call that volume by time, and then volume by price, right? TPO and volume profile. When you put the two together, it allows you a deeper understanding of how much volume happened at that price, and then how much time did we spend at that price. And they're not always the same. The reason it really stands out is if you find a significant level of volume, and yet we spent a very little bit of time there, then it kind of implies that there was a very large amount of volume sitting somewhere, say right at the very top of a range, and price runs up into that range, stays there for moments and falls. It would show up as a very small amount of time spent at that level, and yet there would be a significant level of volume at that level. So laying these two on top of each other like this gives us that kind of perspective. Most of the time, they line up. You can see how the points of control are very close together. But when they don't, that's when it adds some context. We want to carry forward the points of control from the previous days. You can also carry forward things like the value area high and the value area low. I don't really find a lot of validity in doing that, but if you study volume profile, it is something that they talk about, recommend, demonstrate. What I find is that most often that volume profile value area, high and low, very, very often lines up with an institutional pivot point anyways, and I already would have marked it because of my own logic that says I want to mark out, say, a 5 by 5. So if I was to mark the low from Thursday, you can see how it lines up really close with that value area low. I wouldn't have to compromise my own analysis trying to use somebody else's logic. We would both be marking the same pivot, but for a different reason. As long as it gets marked, it doesn't really matter. But I do like to carry forward the point of control, especially if it is an untouched point of control or a virgin point of control. Those carry more validity with me than one that's already been hit. And at the moment, we have an untouched point of control. Kind of zoom in here and make things a little ugly for a moment. The untouched point of control is at 41.33. Should we get down to that level, we would expect a reaction in price. Now, again, the good thing about this is we don't try to assume what that reaction is going to be. Nobody says, well, we're going to bounce there. We're not promising a bounce. We're not promising support, just that when price gets there, there is very likely going to be a reaction. We would be wanting to watch the dome, look for defenders, identify blocks and sweeps, icebergs or ceilings, depending on, if that mark is over your head or underneath you. We're looking at a daily chart here, kind of just reflectively asking, where is the expected move for the week, and are we anywhere near it? Give me that. We're still really close to where we opened the week, or I should say where we closed last week on Friday. That would be the gray line here. So we're above that. We're doing better than when we started, but we really haven't gone anywhere. No surprise, right? Thanks, Captain Obvious. But we are looking for an inside day breakout. We've been looking for an inside day breakout through all of this. And when we get to the top of this zone, if nothing's changed, if we didn't get there because of news, if it was just a slow grind that got us to the top of the box, be ready to turn around and go back in the other direction, because we're very likely not going to get out of that box without some push. As you can see with this lower indicator, this is the advanced decline. It's a weighted advanced decline. It very clearly showed the market was going to make a move off of that low yesterday, or it continued to validate the strength of that move off of the low yesterday, I guess is another way that you could say it. This is a normal advanced decline line. It also, as you could see, was validating the same thing. We started out really negative, got back up above the zero line. By the end of the day, we were running at a highly correlated market coefficient. But it wasn't extreme, right? We actually went into the day with 421 names advancing. That's a good, strong, bullish day, but not an extreme day, right? In the Nasdaq, that was 86 out of 100 names advancing to the upside. The volume really turned around on both of these. The lower chart here is accumulated volume, and again, those started out negative and then actually worked its way up and through into a positive day. Looking at the cumulative tick, same thing. Really clustered at the beginning of the day. Everything was really tightly wound. Nice Russell breakout. We've been using that Russell breakout or Russell crossover as a distinguishing characteristic of market sentiment, changing significantly. And nobody knows why the indicator really works that way. We didn't know when it was built that the Russell was going to be such a powerful signal. But when that green line crosses over its peers and starts breaking in one direction or another, we pay attention. We pay attention because we're getting an absolute change in market sentiment. And so the start of that rally yesterday, the confirmation of that move, or the validation of that strength, was there all day. And that's nice, because we haven't had such clean signals in the last few days. It's been some really muddy waters lately. The ticks are a great example of that muddy water. We did spend a considerable amount of time in the red with no crossovers at all. I mean, it was just straight up in the red, and price reflected that nicely. But that was also right into the lunch range, where we wouldn't have expected any sort of breakout, any sort of continuation, any sort of retesting of the lows. We would have expected it to consolidate, hold the level, and get through the other side of lunch. So the ticks turned red, maintained really well, and then we got back into the green. And sure, I mean, there's no argument. We did cross down into that red a few times, but those were very minor cross downs, and otherwise we stayed predominantly in the green all day yesterday, showing yet again strong sentiment in that move yesterday. So, it's in the current market, it's hard to have trust. Kind of the old Reagan thing, trust but verify. Well, it's hard to have trust in this market right now. But when we went through and we talked about things yesterday, We marked out all the levels. We talked about the fact that we were inside day and that we were at the bottom of a very strong range. And when you're at the bottom of a very strong range and you start moving to the upside with every single market signal telling you that it's moving with strength and conviction, what do you got left to do but run it? The difficulty is when you get these extreme candles. It doesn't really leave you much of an opening to get in there. And I think where most people are struggling with this is they are taught to trend trade. And in a trend trade, you wait for a pullback. You buy low, sell high. I think we've all heard that, right? We got the t-shirt, we got the hats, buy low, sell high, get the bumper sticker. But if it's a momentum breakout, it's not going to pull back and let you in. You have to buy high, sell higher. Or, if it's to the downside, sell low, buy back even lower, right? So you need a plan to be able to deal with the strategy or to deal with a market making such an exaggerated move. That one offered plenty of pullbacks. Here, for an example, with that liquidation break that we had the other day, once it started to go, it didn't really offer you a lot of opportunities to join in and participate. It just kept going. So you got to have a plan for the more of an impulse move where it really just doesn't let you in, and trying to figure out, well, how am I going to get in there? Because these 5 candles here, or 6 candles, are completely different than those right there. And yet, if we were to measure them, that's not too different in the distance traveled. It all comes down to having a plan. And of course, right, we never know that it's this until we look back, because it's always really easy to look back and talk on it, but it's not so easy in the moment, which is why we mark out these levels that we're talking about. If it gets to this level, what do we expect? What are we watching on the dome? What do we need to validate and verify that that move is still going, that there's still strength and conviction in it, and that I could come in and get another bite of the apple? We get to the next level, same questions. We reevaluate and do the same thing over again, right? We continue to ask those questions. Can I still come in and get another bite? Is there still strength in this move? All right, so we're looking at the Nasdaq here. Kind of the same questions. We want to start out with the higher time frame. Where is the expected move? How wide is it? Where are we in relation to it? We're doing better than when we closed Friday. Still maintaining that range. We are inside day. And we're very close. We're messing with the pivot point from where we closed yesterday. It's one of the easiest ways to mark where did we close, because there's so many closes, right? There's the 4 o'clock close, there's the 4:15 close, and then there is a 5 o'clock close. So when you're on the intraday and you're trying to figure out, well, which close should I use if I'm going to mark the close here, that can be confusing. But if you go out to a daily chart and you mark the close, there's only one close there, and it's the one that the broker deemed the end of the day. It kind of removes all of the confusion. So in the Nasdaq, we got a 3.3% ADR. Goodness. So nice and easy from where we closed. We want to measure out a 3.3% move, which gets us really close to 13.1. To the other side, 12.26. All right, so that's our ADR range for the day. Now remember, ADR is not the extreme of the day. It is the normal of the day. It's what we think the market could do if it just does what it normally would do. So if we hold that thought for a moment and we think about this range that we've been fighting, if we break this range today, those ADRs, we're going to run them right over. Um, Not really, no. Well, okay, kind of say it another way. How are we even measuring the ADR? From the highest point to the lowest point of that daily candle, that was measured. And then the next day, from the highest point to the lowest point, that was measured. And then the next day, high to low, high to low, high to low. And we did that for 21 days. So then after we did that 21 days, we added up every one of those measured moves from its highest to its lowest point, and then we divided it by 21 because that's how you get an average. So technically, today, if it goes up 1.7 and then it goes down 1.6, did we move that 3.3 ADR? We did, right? But what we want to focus on is from the close, did we move 3.3%? Right? Because if we're looking at these daily candles from a day by day basis, this candle, for an example, after we had opened from the close of the previous day, traveled the ADR in a single direction. And that's what we want. What we don't want is the opposite of that. Say something like this, where we went into the close, we opened it the next day, and we went half the ADR this way and half the ADR this way. And we're able to say, oh, look, we've got our 3.3 ADR today. We certainly did half of it this way and half of it that way, but we want to see a market in a travel. Range days are just bah, right? They're tradable. I love them in options, but when it comes to futures, I want this sucker to move. So what I want is an expansion candle. I want a candle that actually leaves the previous day's range and goes somewhere. That's my go-to. So on a day like that where we had closed and we got into the new day and we run our pre-market analysis and we say that we could make a 3% move in one direction, we want to measure out where is that 3.3 at. Now, having said that, if you take an indicator like the ADR, it's mine, I wrote it, I can put whatever code I want in it. If you take an indicator like that, and I was actually looking today when I opened up the user dialog box earlier in this stream, I had one that had lines it would draw the lines for you instead of me manually drawing them every day. And that's fine. There's nothing wrong with it. But what I didn't like is uh, when I wrote the code, it was splitting that 3.3 in half, just like what we were talking about. And so it would have, 1.65 here and 1.65 here. And it would say, well, if we stay in the middle of that today, that's our 3x3 or, our 3.3%. But that's not what we want to focus on. We actually want to mark out, a 3% move if we went that way and a 3% move if we went that way. So I may just add that code. If I do, guys, I'll announce it. I'll put it into the Discord where we put all the other codes. Chewy, that's a pretty good question. I don't think it was the street, buddy. I don't think it was the street. I think we were just at the bottom of the range, right? And we're all kind of waiting for the week for those CPI numbers. And, when you're at the bottom of the range, you go up. And when you're at the top of the range, you go down. Dead cat bounce is what we were talking about yesterday. Although I didn't get the streamed on YouTube yesterday, so you guys didn't hear it until way late. But it was an anticipated bounce, and that's what we got. All right, so for the Nasdaq, starting from the close, and we've already got our ADR levels marked. Remember that we anticipate we're just really going to hold the line, right? That's kind of the first theory, is that we would just hold the line. You sleep over there. My cat wants to snuggle with my mouse. So from that point of view, we want to break these quadrants down. It's easy to focus on what we're working on when you can put these into zones or levels. So the first quadrant would be from our Globex low to yesterday's highest point. It's a reasonably decent range. From that, you could focus on our own Globex low to where we closed at 4 o'clock. And again, that narrow strip I consider to be valuable, and I don't want to get it tucked in with the rest of this, mainly from the idea that the IB is right there, the initial balance, which is like an open range, but in open range, you get to choose your time. And in the IB, you don't. It's always a 1 hour time frame. That's absolutely right, Dobby. Absolutely right. Right now, everybody's really watching the numbers because they're looking for the Fed to blink. They're looking for the Fed to call a pause. Um, a lot of analysts are putting that on the table right now. So when we're looking at these 3 different quadrants, the main thing right now that we would want to focus on is the current quadrant from our Globex low to yesterday's high. When we leave this range, it'll be game on. And that's what we would want to focus on at that point. A break to the downside, we start tagging through our pivot points. Each one a milestone or a goalpost. When we get there, what was the dome? What was the market participation at that level? Blocks, sweeps, order flow. When we're done with that level, did we make it through to the other side of it? Did we reject off of it? Are we going back where we came from? The other part of that equation is, how did we approach it? Was it with big expansion candles, or did we grind our way down to that level? Marking out that 5 by 5, especially in a market where we've spent days and days and days at the same level, will provide a lot of insight. With the 5 by 5, you're marking out the open, high, low, close. It really is not all that complicated. The difficult thing for a lot of people is to trust these levels. And I don't mean trust like a handrail. You don't lean on these things and put an order right at that level expecting price to bounce. We don't trust them like that. Trust them as an area where price is very likely to respond. When price gets to that level, we absolutely expect a reaction out of the market. We don't know what that reaction is going to be. You can guess or assume or think you know what it's going to do, and you can most definitely trade based on that assumption without waiting for validation. But there's a consequence to both sides of that, right? If you wait for confirmation, you won't lose as often. You just won't make as much money. And you very often have to use a wider stop. So you have to put more money at risk. So waiting for that confirmation has its upsides and its downsides. Taking the trade without confirmation, you're using a smaller stop. You get a bigger win when you do win, but you will lose more frequently. And we all just have to crunch the numbers and say, well, will I still win often enough with this win size to make it right? The difficulty is when people take the trade, risking 5 to make 10, and then close the trade at 2 and say, well, it was green. Can't go wrong taking profits. It's good enough. Oh, that's bad. You can go wrong taking profits. You can't consistently risk 5 to make 2. If you do that, you better have a very, very, very high win rate. All right, so we take the Nasdaq, bring it over to the 10-day, 30-minute. Notice the size of the volume profile. It's very narrow, just like we were talking about. There is a significant level of volume at 12.3. It's near the bottom of that range. It's already on our pivot points that we've marked out. We are near the middle of the range. And when we're in the middle, we could go either way. We could go back to the top. We could go down to the bottom, right? There is no uh, directional bias at that point. When we're at the highs, we anticipate that we're actually going to go to the low of the range and vice versa. But when we're all in the middle, what we could say is the point of control is below us and often acts as a gravity point, and that the TPO point of control is much closer and also provides a little bit of a gravity point. My scroll is just not working today. I'll break it. Hey, it's working now. Throughout the day today, we're going to lose this volume off the low end, and this volume profile will widen back out significantly within the next few days, right? Because we're going to lose Tuesday and then Wednesday. By the time we get to Thursday and all of that is gone, this volume profile will be very large at that point. We'll be reevaluating things from the perspective of where are we now? Near the top of the range, near the bottom of the range. Unlike the ES, there is no point of control to carry forward from yesterday. We've already taken that out. Now, it's worth noting that we had a significant liquidation break in the dollar yesterday. Now, it finally did stabilize. It tried to recover, and we were right back down there again. Keep an eye on the dollar today. I'm personally kind of happy that it came back down because I was trying to get filled in a smalls trade yesterday and I didn't get it on. So I'd like to get another attempt today. But we want this thing to quit moving around all over the place. We need that to settle down. Keep in mind that the dollar has been a proxy for the VIX. And if you look at what was going on in the VIX yesterday, I mean, we always talk about the algos. And of course, as it was happening, you couldn't necessarily say, "Oh, look, the algos are in there trading it." But look at the move of that when you look back and you're able to quantify or validate or make a statement. That is what it looks like when the algos are doing their thing. So the same thing with Bitcoin. When we had that exaggerated move yesterday, Bitcoin did not participate. It finally did get into the game later on, started to make that move, but massive liquidation break gave it all back again. We continue to use Bitcoin as that risk on, risk off sentiment. It is a risky asset. It is seen that way. It doesn't matter if you feel that it's risky or not. It is seen that way, right? That is its perception. So when we see that thing getting bid up, that it implies people are in a more risk on appetite or risk on behavior. And the extremes of that kind of break should draw your attention. When you see things like that, you automatically want to start looking around, kind of validating if it's going on anywhere else. Is it impacting anywhere else? Or did the thing that caused this also affect anything else? And there was a sharp move in the market, but it wasn't as bad in the other markets as it was in here. Same thing when it all starts to consolidate in a very, very tight range. It's really important to keep your eye on that because we're looking for that. It cannot sustain it, right? It's one of the few promises we ever get to make when it comes to trading. It cannot stay there. It can't. I promise, guaranteed, it won't stay there. And the longer that it does hold that spot and stay that consolidated and that tight, the more energy it's building up until you get these explosive moves out of it, like a squeeze. We do have to say, or I do have to say, that it's been oddly chaotic in the last few days where stocks and bonds are moving in the same direction, or like literally the other day, everything was moving in one direction. Gold, Bitcoin, oil, bonds, stocks, everything except the dollar and the VIX ran in one direction all at once. If you're looking for validation of a move, it doesn't get more valid than that, right? When literally every single thing that you're looking at, except for risk indicators like the VIX and the dollar, everything was doing one thing, going in one direction. So continue to lean in on these. They are some of the best indicators that you can get. Price action, right? Just like right now, literally as I'm speaking, everything just began falling really hard to the downside. Liquidation break in the bonds, gold. It's muted in Bitcoin. It's barely a blip there, but strong in the Nasdaq, picking up steam in the S&P, and on the other side of that, the dollar popping to the upside as it came into the open, and the VIX, it's trying to wake up. It's a little muted, but that is exactly what we're talking about. Every single thing on this, except for our risk indicators, are going the other way. Validates the move across the board. Now, the goal of the morning briefing is to help teach you guys how to prepare for the morning, right? I always use the phrase, I'm trying to teach you how to fish. I'm not trying to give you a fish. Of course, what it ends up doing is giving people a fish anyways, right? We end up in that spot just by the sheer nature of, well, we're going through the steps. But we do it early, and we have to do it early. I couldn't do this right before the open. There's just too many things going on. But the idea is you're going to want to revisit this as we get closer to the open because a liquidation break like this could significantly change a lot of things between now and 9:30. So when we start looking through the stock part of all of this at what is up or what is down and by how much it's up or down, that is going to be significantly different when we get closer to the open. All right, energy continues to be the trade, but it is so overexpanded. I don't even want to use the word like overbought, but that fits. It's it's out there a lot, but that still seems to be or continues to be the trade. It was said really well. See if I can repeat it remotely close to how um, somebody else said it. How we articulate these ideas are important. The only scalps worth playing are oil and gas plays. Otherwise, the indexes are chopping sideways for the past 7 days with extreme volatility intraday. Right? Short swings are fine on the short side after this. Short-lived short covering rally resolves it. Energy trends are still fine, although very overextended. Yup, Captain Obvious. So it's the play, but it's the play with the most risk right now because you got to ask the what's more likely scenario, right? After looking at a market or an index or a sector that's made such an exaggerated run in just this part of the year, right? Kind of honing in on January forward, that's a heck of a move. But it's still the only play we got. For this morning, looking at the sectors, there are a few sectors that are doing okay. Right? Healthcare, home construction. But like we've talked about before, be specific about what this percentage is showing you. Is it after hours from the day before, or is it actually this morning's price action? And I would say that that's after hours stuff, that it hasn't had any prints this morning, and therefore it isn't giving us any pre market perspective. Things that have moved this morning, they're the ones that are actually showing us its true colors here, like Bitcoin down over 2.5%, or the devil's metal, silver, down 1.75%, gold, bonds, financials, natural gas. So these legacy sectors really don't give us that perspective that we want for things like the pot stocks or the electric vehicles or commodities. So we want to be able to break those down individually. We're looking at the EV market here, NIO, XPEV, Liato. Again, we want to validate, is that pre-market or not? Yep, that's pre-market. So we do have a number of those that are up this morning, including Tesla, up more than 0.5%. It is feeling that move that we just saw, where all of the indexes are making that break down. So is Tesla, but at least it wasn't caused by Tesla, right? When we're looking at moves like that in the morning, trying to a- ascertain or validate, hey, what caused that? Well, it wasn't Tesla. A lot of these EV markets this morning, guys, look primed for a short trade. This island gapped up. This is a what they call an island reversal play. We would focus on that move from here to there. That creates the island, and we would expect price to stay in that range and then gap back down to below that level. And it creates this island of price up here. That's why it's called an island reversal. You could read about that strategy, by the way, in Hit and Run Trading. I don't remember if it's Hit and Run Part 1 or Part 2, but really good book. It's full of all kinds of great strategies, and the island reversal is one of those strategies. If we get overextended this morning in these names, um, that's very likely where I'm going to put a lot of my attention. Tesla is working on that green line. That green line is a 20-period moving average inside of the Keltner channel. So we had a 20-period crossover. And the resistance in that is 736. When we're looking at this, that really big recovery wick from yesterday is a nice follow through into today for that rally up. We want to focus on Monday's high as our resistance in that 730 area. Right, so the EVs are looking really good. I would spend a considerable amount of time this morning focused on those and kind of game out two theories that they are going to be the ones to short if everything starts to go to hell this morning, or looking for a continuation in those, maybe asking the question, which ones haven't joined their peers yet? Like Ford and GM this morning have not participated like Tesla and Li Auto and NIO has. So if we're looking for a continuation in that move, the old school legacy Ford GMs would be a nice place to look and to target for an opportunity. Whereas if we do continue this move to the downside, then I wouldn't want to go with those. They're already down. I would want to focus on the ones that have the most room to fall, the ones that have moved up in the pre-market. When we take a look at the pot stocks, there's not really much there. They're mostly down. There are a few that are up, but they're up with news, I'm pretty sure. And when it comes to the pot stocks, I mean, there's just not a lot of move there, right? Really low beta. I'll trade them when I got an opportunity, but there's just not much to it. It has been, and it continues to be on the intraday energy. I posted some markets from Investors Business Daily. I get the email from them every day on breakouts and breakdowns. I just posted 3 breakouts from them in the after hours chat. You can swing by there and take a look at them. Now, crypto's interesting this morning. This crypto watch list is the list from the Smalls Exchange. I went over there, I opened up their crypto futures product and kind of poked around in the bag. You know, like what do you guys got in here? That's where this list of names came from. And if you look at the list of names, some of these names are actual coins, but a lot of them are not, right? Like Square and PayPal, Nvidia, AMD. So just like with the electric vehicles, we have some that are exaggerated to the downside and some that are exaggerated to the upside. And I think a lot of these upside ones are still just showing us after hours prints. This one isn't. But kind of poke around. Again, it'd be the same play. If we continue this drop in the indexes, the one that we're seeing on the Nasdaq and the S&P right now, if we see that drop continue, then these names that are up this morning are very likely going to join their peers that are down this morning. And that would be a nice run to take them from their 4% high back to zero and then 2 or 3% to the downside. It'd be a nice run. One thing to wrap up with since I brought it up anyways, when we're talking about a basket of stocks, like using the Smalls Exchange, going over there, opening up their crypto product and seeing what it's made out of, there is a new product um, on the European market. You have to have data that comes from ICE instead of CME. There is a New York Stock Exchange FANG index. And because it's an index, it means it's a basket of stocks. If you keep track of the MOTs, the monsters of tech, Amazon, Apple, Microsoft, Tesla, Facebook, there's always this argument of what should be in the list and what needs to be taken out of the list. Remember, it was FANG, and then it was FAANG, then it was Fangman plus T, and yeah, it's constantly changing. And then you're constantly doubting, hey, do I have this thing made right? Should I take that name out, put that name back in? Well, there's an index now that tracks that. And depending on, where you live in the world, you can trade that asset. But whether you want to trade it or not, you can open it up and look what's in it. What are they using to build their Fang Plus product, right? Because it's a basket of something. So I opened it up and I took a look around. It has 10 names in it. It's worth going and looking at to see what's in there. And to read more about it. But this is their list. And it had Baidu in it, and Alibaba, and Twitter. Now, I added the other Google. It did not have two Googles, it only had one, but I put the other one in there. The nice thing about Thinkorswim is that when you use the plus sign like this, in between each symbol, you can actually load all those symbols into one chart and see how this is showing all of those. So I wouldn't need 10 different charts, just one chart with all of them wrapped up into a single symbol. Think of it like an index. Looking at this would be like looking at the Nasdaq 100 or the S&P 100 or the Dow 30. Only it's 10 names. And you can make the argument maybe that name shouldn't be in there. Maybe I shouldn't have the extra Google. Twitter doesn't belong there. You can argue all you want. This is what they are using. So if you're looking for some kind of validation in what you do, right? If you are second guessing yourself and thinking, I don't know, man, should I really put that in there? That might help, right? That way you have a little bit of consistency or at least something else that's saying, don't worry, you're on the right track. You're fine. Don't change anything. And then if changes do need to be made, it'll be made when they make a change. Speaking of changes, we're really close to the rollover. So keep your eye on the volumes if you are trading in the futures, right? Usually when we get inside that 2-week window, I start watching the next roll contract. And the volume is, we're off, right? We're not even close yet. You can see that the next one is showing a really light volume still, but don't assume that you've got time before they start changing, right? Like I said, we're in a very odd market right now. It's been very weird, very extreme. I don't turn away data, and that is a significant data point. So just keep your eye on the different contract, the next contract, the U series, ESU. We're going to be rolling next week, right? Very likely we will finish this week, and when we get into Monday, we will already be on the new contract. Very likely. I would be surprised if we're not. But keep your eye on that other contract's volume. If it really starts to pick up significantly, pay attention. All right, guys, that's what I got. Be careful, be safe, have a good day. I'll see y'all tomorrow.